All right, good afternoon, everybody. My name is Bobby Rains. Welcome to our Investors Observer members only workshop. So here's our agenda for today. We're going to look at some charts. We'll talk about what sectors and industries are hot right now. That bullet point should be less about Fed reaction than more what the Fed is thinking and update on the Fed in any case. Then we'll talk a little bit talk a little bit about what else is happening. And then member-driven content. If you got questions, you can put them in the box now. If you have a question while I'm talking, feel free to put it in. There will be plenty of time at the end for questions. You can submit questions ahead of time. Obviously, it's too late to do that now, but in the future, you can submit questions ahead of time. I usually try to put together some slides. Sometimes you get a chart, things like that. We did not get questions ahead of time this time, so yeah. More time for those of you who are here to ask questions. But yeah, by all means, we like to get questions for the workshop. Yeah. All right. So moving on. Charts, S&P 500. Our last workshop was about here. And today we are somewhere around here. I think there's a little bit of rally into the close. We didn't close down quite as far as that last candle would suggest. We're certainly not up from where we were the last time. It's maybe not surprising. This is kind of a long rally. You would expect at least a pause, if not a little bit of a give back there. And then, as we'll talk about a little bit later, I think a lot of this is related to the Fed, but there are some interesting splits as you go through and chop the market up in different ways. The NASDAQ has this sort of stranded area here, right? There's a gap here and a gap here. I think it's possible that this dip in the middle might make it not so much this, but a stranded area like this is what some technical analysts would call an island. Sometimes you leave things on an island, sometimes you go back to get them. That's kind of what makes it interesting. But an island can be a reversal pattern. So again, there's a definite cause for some of the reversal here in terms of people being newly worried about the Fed raising interest rates higher than they previously thought. But it's always interesting to me when the technicals, which should be entirely separated from the news other than the basic up and down, when those things sort of reinforce each other, it's kind of interesting to me. And yeah, the Russell is more interesting. It's had a bigger run up, certainly, and gave back more yesterday. Again, not surprising. Maybe the big run up is surprising. It was also down kind of the most last year in terms of these indices. So, it's just generally more volatile. So maybe it's not surprising from that point of view. But it's interesting and sort of fits with the broader pattern of some things we've been seeing and that I'll talk about as we go on. All right, so the S&P 500 versus the equal weight. What's interesting to me here is that we've had this rally this year and the gap hasn't really closed. The rally has been relatively tech heavy, but the gap hasn't really closed here. And obviously, it did slide yesterday. And the reason there's a difference between these two charts is that the S&P 500 is pretty heavily skewed, or at least it can be at times. It's less so now. It can be pretty heavily skewed toward the top companies, right? There have been points where Apple, Google, Facebook, Tesla, Microsoft, just account for, I think it's gotten as high as 20 or more % of the S&P 500 index because it's by market cap. Obviously, those are some of the stocks that got hit pretty hard in the last year. So that percentage is down some, which is why it tracks a little bit closer as we go through the last year. I think it's worth noting maybe that the spread here is interesting in terms of how it's opened up here, and also that it hasn't closed, right? Like we've had a bit of a tech rally so far this year, but the the gap between the two hasn't closed, which suggests that either everything from the whole list of 500 companies is going up, or that Apple, Google, those companies aren't up as some other things. Now, when we get to growth versus value, we can see some interesting stuff here. Growth really did start to close the gap on value here. It obviously gave back more in the slide we've had over the last couple of days, but growth stocks is really what has been picking up here. And I think Apple and Microsoft are certainly not classic growth stocks, right? Like the largest companies in the world, it's hard for them to qualify as growth stocks, right? You can only grow so fast, and once you get to a couple $1 trillion in market cap, how fast can you really grow at that point? So those things have sort of leveled off a little bit. But this split, a lot of times this split has been roughly the same. And it's interesting to me this time around that it is this different. And I think it says something about those big tech companies and what's actually leading the market. So yeah, what else is going on? Oh, hang on. This is a slide from last time. Sorry. I thought this was not where I had this in my agenda, and it's not. All right. Here we go. What sectors and industries are hot right now? Thermal coal is back at the top. It got bumped off a couple of weeks ago, but now it's back. It's been at the top for quite a while. And a lot of that's because it's a relatively small sector, and so one or two stocks can be kind of strong. And then oil and gas drilling, oil and gas midstream. This is how it has been for a while. Oil and gas drilling versus exploration and production, or sometimes midstream is up there, but oil and gas has been up here. And that's because energy prices are high. And not only are energy prices high, but unlike what we've seen some in a few sort of previous cycles, rather than a big increase in money spent drilling, energy companies are returning money to shareholders. Dividends are pretty high. Some of them are buying back stock. They're not getting overextended on the CapEx side, which isn't great for energy prices for those of us who have to buy gas all the time. If they did more drilling, the price of gas would go down, but the price of gas and oil stays high, then those companies are more profitable and their stocks do better. Utilities is interesting. It's, I think it's a little bit of a dividend play. It also ends up being kind of a flight to safety thing. It's the kind of thing people buy when they're worried about a recession. As is energy to some degree, although energy can certainly get hit pretty hard in a recession also. But yeah, and then the rest of the list, industrials, financial services, consumer cyclical, on the sector side, we'll go through them some of them anyway, one by one here. Industrials was on the list before. It's been on this list for a while. And again, these are still, right, like the economy's doing well kind of industries, right? Or at least the sort of companies that do well when the economy is doing well. Infrastructure operations, airports and air services, metal fabrication, right? Like that is, people are traveling, people are paying to move things around. People are spending capital to have things built, things like that. Financial services, this seems to be, I don't know, the strength of insurance is a little bit interesting to me. I think some of it is due to earnings. The brokers popping up here is maybe a little bit surprising. Like reinsurance and life insurance makes sense in terms of a higher rate environment. Those companies will do better. I will admit to not paying a ton of attention to insurance rates outside of the insurance that I buy on a regular basis. But that's the kind of thing that would push the brokers higher. Higher interest rates aren't necessarily good for brokers. reinsurance is essentially insurance for insurance companies. Insurance companies essentially buy a bunch of risk, and then sometimes they find out they have too much and they need to chop it up and move it around. And so that's what reinsurance does. Life insurance is pretty obvious, and it is in a lot of cases an interest rates kind of play. Consumer cyclical, residential construction, resorts and casinos, footwear and accessories. Again, these are things that do well when the economy is doing well. What's interesting to me when I look at this list is it's much less split. Like consumer cyclical was actually replaced in that fifth position, or actually it replaced consumer defensive, which is the, food and, canned goods and that kind of thing stocks. So it's interesting, right? The market's opinion of the economy seems to be changing here a little bit in terms of, it's been telling a mixed story for a while, but it seems to be leaning much harder into the economy is good camp than the, oh no, we're worried about the economy sort of camp. This data comes from, if you go to stocks and then sector and industry, we have this page here. You can sort the sectors by any of our 7 scores. I sort by short-term technical for this presentation. You can click into one here, let's say industrials, and see the top companies and also the top sector, or the top industries in that sector. And if you want to click into one of the sectors, you can again see the top companies just in that sector. So this is just another way to sort of drill through the stock market and find what's strong. If you want to find the the strongest stock in the strongest sector kind of thing, that's the thing you can do. All right, so the Federal Reserve. I decided to break it out, make it its own slides this time. We did last time because it was right after the meeting. I guess the minutes of that meeting did actually come out today. They weren't particularly interesting and didn't really tell us anything that I felt like we knew. Right, the short story is more hikes are coming, right? This quote, the committee anticipates ongoing increases in the target range will be appropriate, yada, yada, yada. That's from the most recent meeting, that meeting at the end of January, or I guess maybe it was February 1st. In any case, we got some more hawkish comments last week that sort of spooked the market. What's interesting about those comments is that I believe it was the chairpeople of the Cleveland Fed and maybe St. Louis. I think it was Mester, and Bullard. Said, we would support, I think they said sort of independently, not speaking as a block, support 50 basis points at the next meeting. And that's fine and sort of interesting, but neither of them is voting. So the voting for the open market committee changes. There's some people that vote, like, Jay Powell and some people at the top, and then some of the regional, or some of the other Fed officials vote every time, and then among the regional Federal Reserves, who gets to vote changes year by year. They sort of have a rotation. So the 2 people that came out and spooked the market last week by saying we should raise more, those are interesting opinions, and those people are definitely saying that probably in the room where the people who are voting are listening, but the people who are saying that are not actually voting. And I'm not super certain what it means that they're coming out and saying that. Like, I doubt they're totally going rogue in the sense of saying something that the rest of the Fed doesn't agree with to some degree, but trying to figure out how much of that is messaging and how much of that is trying to send some signal that we're going to go up by 50 at the next meeting seems surprising. Or seems hard to figure out, and it's would be a little bit surprising if that was how they chose to send that signal. I think the idea there is to kind of send a signal to the market of like, hey, slow down a little bit. We're not done raising rates, more than it is to signal a specific action. The market is currently pricing in rates topping out, from the Fed at least, between 5.25 and 5.5, which is about 75 basis points higher than the current rate. So that would be 3 more hikes, which would take us to the June meeting at 25. Obviously, if they went up more than that, it would go faster. So this chart comes from the CME, which is the Chicago Mercantile Exchange. They make a market in what the Fed funds rate will be, and from that futures market, you can derive sort of some probabilities of what the market is thinking. And the way to read this chart is these are the sort of the ranges in basis points. And these are the next Fed meetings. And so we're currently at, in here, the between 4.5 and 4 3/4 range. That's the current rate. And you can see most people think we're going to get a 25% or 25 basis point hike, right? That's a 79% odds of a hike there. And the way to read these odds is they should add up to 100 if you go across the horizontal line here. We'll call that a row. So yeah, 79 and 21 add up to 100%. Right, this 21 is relatively new. It's come up recently. Again, see my earlier comments about comments made last week, but that is coming up a little bit. It also kind of squares with what we've seen from some of the economic data. You can see if we look out to May, people generally expect, if you assume that this 79% and this 77.5% are mostly the same people, most people seem to be expecting another 25 basis points after that. And it gets a little cloudy. The general consensus seems to be around, the highest odds are at 425 or 525, 550 at the end of the June meeting. And then a lot of people seem to kind of expect it to stay in that range. There are some people that expect the Fed to start cutting, even cutting below where we are now by the end of the year. I don't have any reason to explain why they think that, but some people are thinking that. But yeah, so that's an idea of sort of what the people who trade Federal Reserve futures are thinking anyway, and I think that's probably not too far from what the Fed is thinking. What's interesting is I don't think this squares with what the stock market is thinking, or at least certain parts of the stock market. So yeah, let's talk about that tech rally. There are some tech things that are up 100% this year. I mean, Tesla is a pretty big company, right? It's up basically 100% this year. Now, it was down, it lost more than half its value last year, and it's now doubled. So it's still nowhere near where it was at the peak. But it went from 100 to 200, so that's, we'll call that doubling. So the questions I have about this big rally in tech shares is if rising interest rates was bad in 2022, why is it fine now? And especially if future interest rate expectations, right? Like I think since January 1st, the expectation for how high rates will go has only gotten higher. So I'm not sure why, if tech stocks sold off in 2022 because of higher rates, why they should be higher now. The economic data has been stronger. Earnings forecasts, though, don't really seem to be picking up. So it doesn't make a ton of sense to me. I think there are some people betting on sort of a soft landing. That does seem to be a much more likely outcome now than it did 3 or 4 months ago in terms of how high rates have gotten, inflation starting to soften a little bit. It does seem like that could happen. It's possible people have decided yields don't matter. I don't really think that's true because I think that I think they matter less for the consumer. I think they matter a lot for tech companies, though. And so with all that said, I'm kind of not really buying it. And the reasons for that are, I can't think of a big time recently where there's been a big downward move in markets like we saw for almost all of 2022, and it was reversed by anything other than the Fed loosening rates. I mean, you have a big day where things go down because people are worried about the war in Ukraine or something like that. But even then, the Fed came in and did some things around the margins, around the invasion there, to sort of shore up the monetary system. And they are pretty much pulling back from most of those things in the name of tightening financial conditions. I certainly think if it looked like something was going to break, they would probably step in here, but they would probably think twice about doing it in a way that was likely to just push more money into the system. They're generally trying to tighten things. And so that's one thing. Now, this is not to say that I think the market shouldn't rally until the Fed does something. I do think we can reach a higher interest rate, or we can reach a terminal rate where the hiking stops and the market sort of normalizes a little bit. I don't think, wait for the Fed before you buy is not what I'm trying to say here. What I am trying to say is it seems weird that there's been no change from the Fed. In fact, if anything, people are expecting more tightening from the Fed, and all the people who were spooked about the Fed tightening are suddenly buying tech stocks. It doesn't make any sense. A lot of big tech is still struggling business-wise. Like I mentioned Tesla earlier. This doesn't necessarily apply to Tesla. I think Tesla has its own issues. But a lot of big tech, if you think about, Google, Facebook, some of the social media companies, some of the companies that are media companies in some other way, your Comcasts, things like that. A lot of those companies make money from selling ads, right? Now, think about how many of those ads you see on Facebook or Instagram, or even on, I don't see quite as many ads on regular television, but I see them on streaming services for other apps, okay? And a lot of those apps are also ad supported. So when people start pulling back on ad spending, it kind of hits some of these companies twice, right? Because you got fewer people putting money into this advertising system, and then there's less money to sort of slosh around where, like, I'm buying an ad on your app, so you can buy an ad on another app, and then we'll all download apps and we'll look at ads together. If people are buying fewer ads, some of that just isn't going to work. The other thing is, flows to venture capital funds are down this year, probably due to higher interest rates. And so what that means is there's less money from venture capital funds flowing into startups to buy a bunch of ads to get people to download their new app. So that's another sort of source of money coming into that advertising ecosystem that's just kind of not there. And also, like, those companies have kind of stopped growing, right? Like, Twitter isn't really growing. Facebook is, they had their first ever quarter of not growing a couple of quarters ago. They're back to growing again, but it's not fast like it was before. And those companies were priced for growth. And so that makes it a lot harder. Tesla is another company, right? They're not in the advertising business, but it's a lot harder to grow when, right? Like, when you're the only electric car company in town, if you want to buy an electric car, you buy a Tesla or you buy nothing. Now you've got Kia and Hyundai and General Motors and Ford and some of the European automakers are all selling electric cars. And so, yes, the electric car market is growing, but your share of that market is shrinking. And so that's tough. All right, yeah, like I said, not all tech is ad-supported. But when there's the other thing is, a lot of those ad-supported companies, when they cut spending, it trickles down, right? think about a big ad-supported company that uses a lot of Amazon Web Services. They may cut their spending or at least grow it slower. So that Amazon Web Services has to buy less hardware. You can see where it sort of has its effect as it goes through things, right? It's going to likely to have an effect on chip makers and other suppliers, even in non-supported sectors. And the thing about the tech hardware sector, right, like your Apples and your Microsofts, replacement cycles for things keeps getting longer, right? So each new, I mean, we saw it with PCs, and we've seen it with other things. You know, when I was younger, every couple of years, computers were just so much better than the computer you bought 2 or 3 years ago. It was ridiculous. And now you can keep a computer for a pretty long time unless you're doing, you know, some pretty video editing, something like that. You might want to keep upgrading your computer, but for most people, they don't need to upgrade their computer very often. And we're reaching that point in phones. Phones just don't need to be upgraded as often, right? Like the difference between the iPhone 13 and the iPhone 14 was not that big. Whereas, you know, the difference between the iPhone 3 and the iPhone 4 was pretty big. So fewer people are buying a new phone every year. People are buying new phones every 2 or 3 or 4 years. And so it's, right, like the phones have gotten a little bit more expensive, but it's harder to grow and you're just not making as much money that way. To get back to growing as fast as we were a few years ago, you need almost a new product category or some big change to an existing category. And yeah, another thing to think about is, right, like I looked this up a couple hours ago. Apple sold a bunch of bonds several years ago. Those are out there trading with a yield of 4.8%. You know, that's less than the average return of the stock market, to be sure, but it's higher than treasuries, and, you know, Apple bonds are pretty safe. You know, it doesn't seem, they're rated AAA. It doesn't seem likely, that it doesn't seem super likely that Apple is going to default on those anytime soon. And so if you're just thinking about where to put money to get some return, that's an almost 5% that seems almost guaranteed. And so people just have a lot more choices of where to put money. They don't need to go to the sort of speculative end of things where it's like, well, sure, this company doesn't make any money, but it's growing really fast and they'll probably figure out how to make money sometime. And then also, back to that replacement cycle thing, spending seems to be going to other parts of the economy, right? Things that people didn't spend money on during the pandemic. I got a few things for working from home during the pandemic. Those will probably last me for a while. I'm good there. If anything, people are going back to the office, and so now, you know, they're less likely to need things. And so, yeah, I just don't see where the spending comes in now. So I'm not saying all tech stocks are bad. I'm, again, not saying wait for the Fed, but I am not really convinced that, like, oh, hey, everything is fine now. It's great to buy tech stocks again, especially with some of them having doubled since the first of the year. That just seems, it seems untenable, and like it may have, the market may have overcorrected a little bit. All right, so what else is going on? Economic data generally seems pretty good, maybe a little bit better than some people at the Federal Reserve would like, in fact. There's also some places where we've seen a little bit of softening, but nothing really looks like a recession. Soft landing very much seems to be in play. That most recent inflation number was higher than I think people expected, and certainly higher than the Fed wanted. But there were some dips as it was rising, right? There were a few times where it came in lower than people expected, and everybody's like, oh, hey, maybe inflation is over, and then it would come back hot the next month. So I think seeing it kind of wobble like that is okay. I'm not worried that it's going to start going back up again. There's a lot of sort of deflationary signs. So I think, such as things are, this is generally pretty okay. Earnings season also I would describe as mostly okay. It wasn't great. It wasn't terrible. Earnings growth projections are certainly sort of coming down. And I think probably that's okay also. Things were just really hot there for a while and now they're cooling off. The housing market I think is getting closer to normal. This is, I think, a function of higher interest rates. Time on the market is getting longer. We're not hearing about those cash bidding wars where people are paying cash at 50% over the asking price for houses. The biggest problem we have in the housing market generally is just not enough houses. It turns out that the housing market is never a market, right? Like the way you get out of the housing market is to die. No one decides they either are tired of taking losses in the housing market and so they won't have a house anymore, and no one ever makes so much money from selling a house that they decide they don't want a house anymore. People who are alive tend to want houses, and so our biggest problem is really not having enough houses. So when you look at those housing market trends, yes, absolutely, the absolute number of sales is low, but home builders are still doing fairly well. I think they would probably like to have interest rates be a little bit lower, but they're still selling every house they build. They're not sitting on a lot of inventory. The big problem really in the housing market is not enough houses, but a lot of the other internal metrics like time on the market and things like that are getting longer and closer to what I would say is a normal market. So the other thing that is, I think, on everybody's radar, or a lot of people's radars, is the debt ceiling. It's not really close enough to be a concern yet. You're absolutely going to hear about it a lot more, especially as we get closer to, I would say, probably June. I'm not sure exactly when the drop dead date is. I don't think anybody is really sure of that. It has a lot to do with how many tax receipts come in compared to money going out. If you're really interested, the first thing to watch is the short-term Treasury note market. Treasury notes don't actually pay a coupon. They don't make periodic interest payments. What happens is it's say $100 face value, and you buy it for 97, and so your 3% interest is basically that $3. So people may not want to hold the ones that look like they may not be redeemed at the time. So the series that would expire in June, you might see some weird things there in terms of prices getting really low and things like that. But yeah, I'm not sure exactly how that works. Nobody's really sure how the plumbing of the financial system will work with things like that. If there is some catastrophe and things go over the debt ceiling, people generally seem to agree that it would not be good. But the ways in which it would not be good, there's a lot of unanswered questions just because it's never happened before. Like people aren't even sure if, say you had one of these treasury notes and it didn't get redeemed in time, could you even list that as an asset in some computers? Because the computer knows that expires at a certain date. It knows it can't, it's programmed to sort of understand that, hey, this isn't a thing I can have on my balance sheet after the expiration date. What happens then? Nobody knows. It's never happened before. So there's a lot of questions about just sort of the plumbing of the financial system, because treasuries are essentially the plumbing of the world financial system. So even if everything gets paid off at some point down the road, any interruption in payments could potentially be really bad. All right, so that is the conclusion of my prepared remarks. As I said earlier, we didn't get any questions ahead of time, but let's look through the questions people have sent in so far. Okay, so Peter says, my question is, if you have rules or guidelines you might follow when doing covered calls. When following along the personalized trades, conservative covered calls, and put ideas, I'm wondering what you do when the underlying in a covered call goes south, but the call option is profitable. So first of all, let's go back to the website here. So for people who maybe aren't familiar, yeah, so we have these trades here. There's some number of them, not more than 3. Very occasionally 0, but usually it's at least 1 or 2. And yeah, they're in these 9 categories: conservative, balanced, aggressive, and then our 3 sort of strategy groups: covered calls and puts, diagonal spreads, vertical spreads. You can find whatever it is you're looking for here. So first of all, that's what we're talking about. And so what to do when the underlying in a covered call goes south, but the call option is profitable. So the way to think about this, and really any of these option trades, is to think less about which side is making money and which side is losing money. Because you entered the thing you entered the two positions at the same time with a sort of goal in mind, right? So let's take this KBH example just as a for instance. Okay, so we're going to buy the stock for $34.51. We're going to sell this option. The net cost will be $32.84 per share. The stock's already trading. It's already up a little bit today, so it's $34.77. But in any case, we're not buying this because we think the stock is going to go up, right? If we really wanted to bet that the stock would go up, we wouldn't sell the call. Or if we did sell the call, we'd sell a call that's much higher out of the money. We're making this trade because of this $1.67 we get for selling the call. Doing that lets us make money as long as the stock basically goes nowhere. So what we're betting on is just the time value in the call expiring. If the stock goes down, yes, the value of the call will go down faster, but also the value of the stock goes down. If the stock goes way up, yes, the value of the stock goes up, but the value of the call will go up basically dollar for dollar after a certain point with the stock. Okay, so this isn't really a bet on the stock. This is one way to think about this is a bet on tomorrow. A thing I like to say sometimes, and it's a little bit snarky, but it's not entirely wrong, is predicting what a stock is going to do tomorrow is really hard. But predicting that there will be a tomorrow, I feel much better about that prediction. Okay, so the reason you get paid $1.67 for selling this call is the option has what's called time value. And as time goes on, there's less time until the option expires. The time value goes down. That's where you're making money in a covered call. Okay, so with all of that said, what do you do when the underlying stock goes down? Well, since the trade here is basically for the value to go out of the call, you can absolutely wait for a little while and then buy the call back for much less than you sold it for. The other thing is consider why the stock is going down. If it's just going down because the whole market is going down and you still like the stock, maybe that's fine. You can buy that call back, sell another one, turn your trade into maybe a bigger winner than it was before, or you can, sell it at a lower strike price and end up coming out with about the same. That's fine. If you decide if something's wrong with the stock, then by all means, yeah, you can sell it. That's fine. And the thing is, because you sold that call up front, you will have lost less than you would have otherwise. Now, if you wake up tomorrow and KBH is at $4, that $1.67 you made on the for selling the call is not going to be a lot of comfort in light of the $30 you lost on the stock. But it's not nothing. But yeah, you can absolutely buy the call back, but think of them less as 2 different bets than as sort of one bet. right? And so, yeah, sometimes when the stock goes down a little bit, you might want to do nothing, especially if you think it'll come back. Now, if it goes down enough that you can buy that call back for a significant profit, then maybe you go ahead and do that. But that's I guess the first way I would approach it. Okay, so a tool says, I'm new. How do I use your portal for short-term trading? So for short-term trading, really the sort of guts of our service here, at least on the stock side, sure, we'll go look at Amazon. So we have these 7 scores, right? And really what we have is we have 6 scores, and then we combine the fundamental score, short-term technical score, and long-term technical score to make the overall score. And yeah, the analyst ranking and valuation are also components of the fundamental score. So all of these things kind of work together. But as you can probably guess, the short-term technical score really matters most to people who are relatively short-term traders. If you're Warren Buffett, the short-term technical score is not the kind of thing that you're worried about, right? Like if you're like, I'm just going to buy this stock and maybe never sell it kind of guy, you don't care about the short-term technical score. You don't care about the stock sentiment. You care about the fundamental score, right? Which is about analysts, the analyst ranking, and to some degree the valuation. Okay, those are the things that I would pay attention to if I was a long-term trader. If I'm a short-term trader, I'm going to look at the short-term technical score and the stock sentiment. So you could certainly start on the top 5 page here, or on the dashboard, and look at the top 5. But like I just said, what you really care about the most is the short-term technical score. So what I might do is go to the stock screener, and you can hit start over and clear things out and say, give me stocks that have a high short-term technical score. And it will do that. And so that's probably a pretty good place to start. You can even sort to find the ones that are the highest. If you say don't like, or let's say you really like financial services, you can click financial services and only get the financial services stocks that have the highest short-term technical score. That's kind of where I would start there. PHI, let's see. Okay, so the next question is, PHI has a 10.6 dividend yield, but your rating is 42. Does that mean to avoid? So about that, dividend yield is certainly, if you're buying stocks for dividends, it's important. But dividend yield tends to be backward looking. Okay, I don't know what the story with this company is in particular. That's a pretty high dividend yield, especially given the price to earnings ratio and the PEG ratio seem to be pretty normal. So I would kind of have expected more people to have bought the stock, which would push the price up and the yield down. So my guess is possibly maybe they paid a special dividend over the last year, or they did something with their dividend where it's a little bit higher than it would be otherwise, because the yield is based on what happened in the past, right? We're looking at what happened in the past, trying to guess what's going to happen in the future. We don't know what the dividends will be going forward. We only know what's happened in the past. So that's one thing about dividends. And the other thing is, like I said a minute ago, the overall score sort of looks at all of these scores, okay? So it looks at, right, all of the scores, and kind of, it's a decent starting point, okay? But if you are an investor who's interested in, say, buying stocks for dividends and holding them for a long time, what I would look at is the fundamental score, analyst ranking, valuation. Certainly if you're buying it for yield, you look at the yield. And in that regard, the stock looks okay, pretty good even. I don't know much about this company outside of what I've just talked about here. But from what I'm looking at here, this doesn't look terrible as a dividend play. I would probably look into what the last dividends were and if there's something funny going on there and if I can expect 10% going forward. But otherwise, yeah, right? Like, so the fundamental score, or sorry, the overall score is a starting point. Okay, it's not intended to be a be all and end all, because we can't do a score that's good for everybody, because people have different goals and different things they want to do, and you just can't make that into one score. Right? Sometimes a 42 might mean all the scores are sort of in the middle, or in this case, it might mean, oh boy, the fundamental and valuation and analyst ranking scores are pretty high and the technical scores are pretty low because the stock's gone down a lot recently. It's hard to tell, just from looking at the overall score, what that is. All right, so let's see. Can you comment on Amazon? Amazon is interesting. It's big, but it is, yeah, again, it's another one of those companies that, once you reach somewhere, yeah, hundreds of billions or $1 trillion market cap, it's just hard to grow very fast, right? That's not how growing works. You just can't grow very fast, or else you lose a lot of money. And I think, or else you gain a lot of money, and you eventually, you just have all the money if you try to do that. And the other thing is, Amazon has really sort of changed the world in some ways, right? Relatively fast shipping that is close to free is kind of a thing that doesn't set Amazon apart anymore. A lot of companies have that now. Now, the thing Amazon does have going for it is it's kind of a conglomerate. It has a retail business. There's the Amazon Web Services business. There's the Prime subscription service. There's a bunch of stuff going on like that. So it's a little bit diversified as opposed to being just an online retailer. But I do think that it's less dominant there, and they are also spending a lot of money to, they're still expanding AWS, they're building out some things, and it's hard to see where they keep growing. People have been saying it's hard for Amazon to keep growing for a long time, so I'm not going to say they can't. But it is hard for them to do that. Also, I think it's probably not, well, let's say it's probably noteworthy that Jeff Bezos walked away when he did. I don't think if he had a chance to double the size of Amazon in the next 5 years, he would have stepped down when he did. I think he probably had gotten to a point where, right, growth gets a lot harder when you get real big. And I'm less sure that he wanted to just run this giant company that he had built. I think it was probably fun to build and less fun to manage. And so, if you have as much money as he does, you can walk away, and that's fine, and you can let somebody else be the manager. It's not to say every time a founder leaves a company, it means the company's going to stop growing, but Bezos is fairly young. He had some other interests. It's not like he's retiring. I think he just decided he wanted to go do something else that wasn't manage a large business. All right, so David says, is financing for biopharma companies holding up in the face of rising interest rates? I don't know about biopharma in particular. I've seen some stats about the venture capital industry as a whole that suggest that it's not. Certainly any borrowing they're doing has probably comes with a higher rate now. And also a lot of those companies, the stocks are down from where they were, say, a year or two ago. And so that means equity financing is more expensive for the ones that are public, just as far as that goes, right? If you're going to raise $1 million at $100 per share versus $50 per share, you got to push twice as many shares out the door to get that $1 million now. And so that means the existing holders are facing more dilution from that sale. So just in general, I'm certain the financing is more expensive. Is it drying up or hard to get or something like that? I really couldn't tell you. I'm not really tuned into sort of that part of the world. All right, so Peter said, is there an online detailed guide for the option screening tool? So we do have some stuff in the Help Center. There's a video about, well, I guess, the strategies that are there. A lot of the things are defined if you go to the glossary or also option screener. Anytime on the website you see one of these blue eyes, you can click it and it'll tell you what you're doing. Obviously, that just tells you what the option screener was, but say you want to know what ITM means, it means percent in the money. Expiration before earnings, it means will the call or, will the sold option expire before earnings? So yeah, we have things like that. We don't have a big guide. If you have some more specific question, you can hit the help button and send it to us, or you can ask it here and I'll try to answer it. Either one of those is fine. Sure. So we have a request to look at Clove, which I was actually looking at earlier. Yeah, this is kind of an interesting case. So this company went public through a SPAC, 2020, early 2021, something like that. But essentially they're providing technology services to doctors, is basically what they're doing. And so it gets a very high fundamental rating, largely because of, right, it's projected to go up kind of a lot. Now, the thing about that is there is sometimes a lag between a stock going down for some reason, say maybe earnings that weren't as good as expected or something like that, and analysts updating these forecasts. So this might be a little bit of a mirage, especially given that the average rating is a hold. I don't think very many analysts have a hold rating on a stock they expect to go up 84%. So my guess is this will probably come down over time and then the fundamental rating will go down. Clover's interesting because if we look at, say, let's look at 5 years. It doesn't have 5 years, but yeah. It traded as high as 16. It's trading for $1 now. You assume the SPAC went public at 10. So the sort of, it literally was $10 of the, right? They just went out and bought $10 of this company for every share. And I think a lot of things got overhyped. Things like this, I mean, if you just think about like conceptually, health investment, healthcare, they provide technology to collect, structure, and analyze health and behavioral data to improve medical outcomes and lower costs for patients. That is great. It's probably a good business. However, think about what it takes to grow a company in that business. You've got to sell it to a bunch of doctors' offices. Now, consolidation has made it so you have to sell it to fewer than you used to, but you have to make a lot of sales, and I can tell you, having worked on some big IT projects and even some small IT projects, integrating something like this into a bunch of people's workflow, especially if, right, like, don't get me wrong, doctors are very smart, but they didn't go to school for 7 years to learn how to use computers. They learned a whole bunch of other stuff. So trying to get people to adopt new technology, especially in a field like that, can be hard. And so I'm not sure that that valuation was ever really worthwhile. And we've seen this with a lot of SPACs. Virgin Galactic is another one in a totally separate industry, but it has a pretty similar looking chart if we go out to all time, right? Like, it went public at 10 and went all the way up to 60. Some of the electric car companies that went public through SPACs. This tends to happen. A lot of SPACs end up not doing well. Some of them may turn it around and some of them don't, but a lot of times they are, a lot of times that $10 ends up being a pretty high price, and certainly any price above $10 for some of those companies ends up being kind of high, just because at some point a SPAC is just a bucket that's worth $10 a share. And so the idea of it being worth a lot more immediately is just kind of hard to think about. Credit Suisse, man, Credit Suisse is an interesting company. I know they're spinning off some part of their investment bank into, I think they're going to bring back the First Boston name. But yeah, if you look at this chart, I mean, no bank has really come back from the pre-crisis time, so I'm going to forgive them this part of the chart. But this, right, like from the recovery on to here, is kind of on the management. We can look at, let's look at, say, Bank of America, which maybe isn't exactly analogous, but it's close. Bank of America didn't have the big bounce back, but since then it's gone up. Put in like a Morgan Stanley or something, which is a little bit more investment bank, which is maybe a little closer to Credit Suisse. That's certainly done a lot better, right? I think a lot of the problems at Credit Suisse are sort of unique to Credit Suisse in that sense. Now they've got a strong brand. They're spinning off First Boston. That should get some new management to some part of the business there. Just generally, companies that tend to underperform their sector for years at a time, right? Like, a lot of that is on management. And I don't follow Credit Suisse that closely. I don't know what kind of management turnover they've had. But at a certain point, it becomes about the corporate culture, which is not to say that this trend is going to continue. And if it's a tiny amount of your portfolio and the question is about like buying leap calls on it, maybe it's a worthwhile bet. I don't know. But this sort of like years long decline here, and Credit Suisse has had some number, right? Like, I think Credit Suisse just always seems to be on the wrong side of some number of mishaps in the financial markets. When that Archegos Capital, that hedge fund, blew up a year or two ago now, Credit Suisse was the big loser from that. They've just sort of been the big loser on a couple of different cases where it seems like they sort of shot themselves in the foot or were poorly managed in some way. And so, yeah, as a financial, I don't love it, right? Like, as something to take a flyer on, because maybe it turns around and it's a $3 stock, and one of the few $3 stocks that has leaps and has some brand value and some, hopefully some asset quality there. It might be an okay flyer. It's certainly not a thing I would make a significant portion of it. Long-term leap calls is not a thing I would make a significant portion of my portfolio anyway. But in this case, as a speculative bet, it might be okay, right? Like there's some reasons to think the company won't disappear or go to zero, but I don't know. For me, it's really hard to overlook this record of performance and imagine it just turning around because the stock got real low. I don't know. I don't have a good case for it to turn around. They're doing some things, like I said, spinning off First Boston, some stuff like that. They're not doing nothing, but I would kind of like to see the stock come back, even if it meant that I made a little bit less money on my investment. I would like to see things start going in the other direction before I really put much money into that. All right, so it is a little bit after 5. I thank everyone for coming today. This session, like all of our workshops, was recorded. It will show up on the news section of the website tomorrow. We'll send you an email when it's out there. If you want to find previous workshops, you can go to the personal finance section, and these ones that are tagged Investors Observer Workshop are the workshops. So they're there. If for some strange reason you feel like you need to listen to hours of me talking, there's hours of it right there. But yeah, the next workshop will be in 3 weeks. You can reach us anytime by using the help button here on the website. We get back to most of those same day. Thank you for coming. Thank you for subscribing to Investors Observer, and I will talk to you again soon.